A financial crisis in the next 3 months. The devaluation of the US dollar is just the first step. The real fatal blow will be triggered after 90 days, which means at most 3 months from now. This is exactly the final period that the US government has given us. If the US Federal Reserve and the entire world still refuse to compromise, then the next step will be a financial crisis even more devastating than 2008. Just this month alone, stocks and bonds have already caused countless people such suffering. And in less than 3 months, it might not just be stocks or bonds, but the entire global asset market collapsing. But it is precisely at that moment that we, the holders of safe haven assets, will have the opportunity to realize profits and buy at the market's bottom. What do I mean? Golden Rules warmly welcomes you all. Everyone, you might forget your girlfriend's birthday, or you might forget your wedding anniversary with your wife, and at worst, you might lose a few Hermes bags. But if you forget an important day this year, the wealth you've worked hard to earn over the years will be wiped out in the blink of an eye. That day is the last day of June this year. Why? Because the $6.5 trillion debt that the US borrowed previously will come due in June, precisely on the last day of the month. At that time, we will know how the US plans to handle this debt. You might think, if the US doesn't pay its debt, what does that have to do with us? Why is it such an important day? In fact, even now, many people still haven't realized the severity of this situation. The $6.5 trillion debt that the US has to repay in June this year was largely borrowed during the pandemic. At that time, the economy was in decline, and the US stock market was even halted multiple times. During that period, the Fed continuously expanded its balance sheet and pumped money into the market, then lent that newly printed money to the US government and capitalists at near-zero interest rates. This means that the $6.5 trillion debt the US has to repay in June this year has very low interest rates, almost zero. But what's the problem? Right now, the US government's treasury only has a few $100 billion left, which is not enough to repay the debt. So their only option is to borrow new debt to pay off the old debt. But in recent years, the Fed has continuously raised interest rates. Currently, the US has to borrow money at an interest rate of about 4.5%. What does this mean? It's simple. Let's say I lent you $1 million 5 years ago, and I agreed that as long as you paid me back $1 million in June this year, I wouldn't charge you any interest. You'd be thrilled, right? Because for the past 5 years, you spent freely without worrying about interest. But now, you've spent all that money, and you can't pay me back. So what do? You have to borrow $1 million from someone else to pay me back, and now you owe that other person. This is the form of borrowing new debt to pay off old debt. But the problem is, the person lending you money now requires you to pay 4.5% interest per year. That means after 5 years, in addition to repaying the $1 million, you also have to pay over $200,000 in interest. Got it? U.S. bonds work the same way. During the pandemic, the U.S. borrowed debt at very low interest rates, almost zero, so they spent freely. Now, the U.S. Treasury only has a few $100 billion left, while the $6.5 trillion debt is about to come due. The U.S. is forced to face repaying this debt. But what if they can't pay it? So, the U.S. has no choice but to keep borrowing money from others, using new debt to pay off old debt. But what's the problem? The new debt now comes with an interest rate that has risen to about 4.5%. This means that by June, the U.S. will have to shift from previously paying no interest to paying an annual interest rate as high as 4.5%. In other words, the U.S. is turning low-interest old debt into high-interest new debt. Currently, the U.S. government treasury only has a few $100 billion left, and that amount is not enough for spending. It's estimated that by June, it will be completely depleted. At the same time, also in June, the U.S. needs to repay the old debt amounting to $6.5 trillion. Unable to repay the old debt, the U.S. will have to borrow new debt. That means borrowing at a high interest rate of 4.5%. What's the most critical issue? It's that even if the U.S. wants to borrow, there might not be anyone willing to lend anymore. Why is that? In the past, the interest rates on U.S. government bonds were very low, but countless people were still willing to lend their entire wealth to the U.S. For example, if you had $1 million in assets after 5 years, the U.S. would only pay you back $1.02 million, including both principal and interest. This return rate couldn't keep up with inflation at all. But even so, people still scrambled to lend money to the U.S. and buy U.S. bonds. Why? Because U.S. bonds always increased in value. In the past, when you lent $1 million to the U.S. would give you a promissory note worth $1 million, which is a U.S. government bond. You could take that bond to the market and sell it. Sometimes, in just one transaction, you could sell it for $1.1 million. That's because the price of U.S. bonds used to consistently rise. Therefore, many people wanted to lend money to the U.S. because the earlier you lent, the cheaper you could buy U.S. bonds. Later, when the bond prices rose, you could sell them for a significant profit. In other words, U.S. bonds were like a speculative tool for profit. You can look at this chart. If you bought U.S. bonds in 2014, meaning you lent money to the U.S., by May 2020, the value of the bonds you held had doubled. 6 years, doubled in value. And because so many people were scrambling to buy U.S. bonds, you didn't have to worry about not being able to sell them. Moreover, who's the debtor? It's the United States, the world's hegemon. You didn't have to worry about them not paying you back. Therefore, U.S. government bonds have always been considered risk-free assets. You can understand it simply like this. In the past, when you bought U.S. bonds, if their value dropped, you could just hold on to them and the price would rise again. Even if it didn't rise when the bond matured, you could still demand a U.S. government repay you. In other words, buying U.S. bonds was almost impossible to lose money on, and they could even double in value after 6 years. Because of this, many people use financial leverage to buy U.S. bonds. For example, today you have $1 million. You use that $1 million to buy U.S. bonds. Then you take those bonds to the bank to pledge them and borrow $950,000 in cash. Then use that $950,000 to buy more bonds. Pledge them again to borrow $900,000 and keep buying more. By repeating this process of buying bonds, pledging, borrowing, and buying more, people could use leverage 7 to 8 times. This means that with just $1 million initially, you could buy $5 to $6 million worth of U.S. bonds. But if you look closely at the chart, from May 2020 onward, the price of U.S. bonds started to continuously decline. Think about it. Today, you're a bank, and a customer brings $1 million worth of bonds to pledge and borrows $950,000 from you. If the value of those bonds drops to just $950,000, it's already dangerously close. If it drops further to $900,000, do you think that person would want to repay you $950,000 to redeem bonds now worth only $900,000? Definitely not. So, when bond prices start to fall, the bank will immediately demand repayment, meaning those who borrowed with 7 to 8 times leverage will be aggressively pursued for their debts. They're forced to continuously sell bonds to repay the debt. And this selling frenzy, in just 3 years, wiped out all the accumulated growth of U.S. bonds over the previous 6 years. Why did U.S. bonds plummet so badly? It's because China and Japan have been selling off large amounts of U.S. bonds in recent years. The key point is this. In the past, people rushed to buy U.S. bonds because they kept rising in value. But now, U.S. bonds are continuously falling, entering a bear market, and even countries like China and Japan are frantically selling them off. In recent years, a series of U.S. banks have collapsed because they held too many losing bonds. So now, do you still dare to buy U.S. bonds? Currently, the U.S. Treasury is almost depleted, and they're about to borrow at high interest rates. But even if they offer high interest rates, there might not be anyone willing to lend anymore. So what can they do? U.S. bonds are now like a very long and very old house that could collapse at any moment. You can choose to keep repairing and renovating it, but no matter how much you fix, it only makes the exterior look slightly better for a moment. The old foundation remains the same, and the risk of collapse is still there. But that's okay, because you have another option: blow up the house and rebuild from scratch. In other words, if you're the U.S. government, you can keep trying to sustain the life of U.S. bonds, or you can choose to die and be reborn, blow up the entire U.S. economy, drag the global economy down with it, then rise from the ashes, making the U.S. once again the fastest recovering economy and rebuilding the house from the ground up. So which option would you choose? In 2008, the U.S. chose to blow up that house. And now, they're once again standing in front of a time bomb that will trigger a global economic crisis. If you've experienced the despair of the 2008 financial crisis or the panic when a U.S. stock market halted trading in 2020, you'll understand that those who think this has nothing to do with them might lose all their wealth on the last day of June. But at the same time, those who grasp the script of this game early can seize wealth. If you don't want to be a victim of this game, and even want to leap up the social ladder, you can follow my channel because I plan to provide you with more information later. And if you're afraid you'll forget after listening, meaning you're wasting your time, you can like this video so it's automatically saved to your playlist, making it easy to come back and follow later. So how exactly will the U.S. government solve the problem of switching from low-interest debt to high-interest debt and the issue of having no money left to spend? There's only one answer that makes the U.S.'s big bosses step into rescue. The Federal Reserve must turn on the money printer, use the printed money to buy U.S. bonds, and then lend it to the U.S. government to spend. Moreover, interest rates must be lowered, ideally back to 0%. But here's the problem. Why would the Fed have to help the U.S. government? Because if no one buys the bonds, the U.S. won't be able to repay the $6.5 trillion. And at that point, their only option is to declare bankruptcy, admitting that those promissory notes are just worthless paper. Everyone who lent money to the U.S. won't be able to get their dollars back. The money you lent to the U.S. is as good as gone. And if a major country like the U.S. can blatantly default, the entire world will immediately flee from the U.S. dollar, then switch to other types of assets. It's simple like a bank. In the past, why did I deposit money in your bank? Because I thought my money was safer with you than at my house. But now, your bank declares bankruptcy, meaning the money I deposited might not be recoverable. So don't I have to quickly withdraw my money? And why do we use the US dollar? Because I feel holding your dollar is safer than holding my own country's currency. For example, if you're Ukrainian, your country is being ravaged by war, but as long as you hold US dollars, you can still preserve your wealth. The most important thing is that the US dollar is tied to US government bonds. To buy US bonds, you need US dollars. That means you have to hold dollars to lend to the US government. But now what? The US government defaults and stops paying. The value of the bonds I'm holding instantly becomes zero. So do I still want to hold US dollars? Is holding your dollars still safe? A bank default leads to conflict. A US government default does the same. What's the countermeasure? Everyone will sell off US dollars and switch to other safe assets. Once the US dollar is no longer backed by US bonds and the US government defaults, the dollar will face an unprecedented sell-off, turning into worthless paper, and all assets in the US will become valueless. Therefore, the Federal Reserve cannot afford not to step in and rescue. If they don't, the capitalist tycoons behind the Fed, their money and assets will also vanish into thin air. In other words, whether the Fed expands its balance sheet or prints money to save U.S. bonds is not something to think about. Would the capitalists want to die along with the U.S.? Moreover, the Fed has already stopped shrinking its balance sheet this year, meaning it's stopped withdrawing money. The next step is to expand the balance sheet, print money, and pump it back into the market. So saving U.S. bonds is a certainty. But how can the Fed choose to save them? The first way, I can expand the balance sheet, print money to buy U.S. government bonds. But I don't have to lower interest rates. I can still keep the high interest rate of 4.5%. Many people say, is 4.5% considered high? Friends, in the past, the U.S. government borrowed money at almost no interest, near 0%. Now it's 4.5%. Isn't the borrowing cost more than 4 times higher? And they're borrowing trillions of dollars. Even just 1% interest is already a huge amount. But if you borrow a few tens of thousands, even at 5% interest, it's nothing. So, if the Fed doesn't lower interest rates every year, the U.S. government will have to work for the capitalists behind the Fed forever. Simply put, the American people earn money, pay taxes to the government, and then the government uses that money to pay high interest to the Fed and the tycoons holding short-term bonds. If the US dollar continues to maintain such high interest rates, more and more US businesses won't survive and will go bankrupt, because even the US government has to borrow at 4.5% interest. So if you start a business and issue bonds, the interest rate will be even higher, right? With such high interest rates, if you can't pay, you have to go bankrupt. And if you go bankrupt, many people will lose their jobs. Unemployment leads to less spending, and the economy goes into recession. A recession will lead to the collapse of both stocks and bonds. At that time, people like Warren Buffett, who have already sold off US stocks and are holding a pile of cash, will be able to buy up US assets being sold off at rock-bottom prices. During this period, Buffett isn't just holding cash, but also holding tangible assets, meaning short-term US bonds from 3 months to 1 year. By then, the US government will have to repay Buffett both principal and high interest. In other words, Buffett not only lends to the US government at high interest rates, but when he wants to buy in, he can convert short-term bonds into dollars and hunt for cheap assets. This is what we talked about at the beginning. Right now, there's a very long and very old house, which is US bonds. You can repair and renovate it, meaning let the Fed back it up. But this house will still be long and old. Still no one will buy it. And the interest rate will still be decided by the Fed. Still a noose in the hands of the capitalists to strangle the US. So, Trump has never asked the Fed to expand the balance sheet or print money. He only asked for one thing: lower interest rates immediately. But the Fed has been very clear, I won't lower them. So what options does the US government have? The only way is to blow up this house, let US bonds collapse, let US stocks collapse, and drag the US dollar down with them. Why? To force the Fed not only to print money, but to print it on a large scale and at high speed, while also lowering interest rates to the lowest possible level. Because when the market collapses, if the rescue is even slightly slow or weak, it won't be enough to save it. And that bomb is global tariffs. Smarter people will see that whether the Fed doesn't lower interest rates and prints money slowly, or is forced by Trump to lower interest rates and print money quickly, the end result is the same. U.S. assets must go through a steep decline or even a collapse. But do you know? Every collapse is a moment of wealth redistribution. In the 2008 financial crisis, some people went bankrupt and jumped off buildings, while others bought at the bottom and became rich. The 2020 pandemic caused small retail investors to lose everything, while hedge funds easily tripled their profits. And this year's crisis will be the last chance for ordinary people to change their lives. Why do so many people lose money when the market crashes? Because those who don't hold stocks blindly try to catch the bottom, only to catch it mid-slope. Those who hold stocks either panic and sell at the bottom, or stubbornly hold on hoping to recover, but fail. The result is you miss the opportunity to make money from both the sharp decline and the sharp rise. If you're still brainwashed by irresponsible strategies like hold long-term and it will rise again, your wealth will be completely crushed by this era. So you absolutely must learn to recognize the peak signals before the market collapses to lock in profits in time and seize opportunities when the trend reverses, leading to a sharp decline. Therefore, the key point is that right now, the Fed hasn't lowered interest rates, but that doesn't mean they won't when the collapse happens. If we only look at the results, right now, US stocks, US bonds, and the US dollar are all plummeting at the same time, but the price of gold is soaring. Isn't this exactly following the prearranged script? The first step is the devaluation of the US dollar. Suppose there's a house worth $1 trillion. Do you think it's expensive? Most people would definitely think it's very expensive. But what if I told you that $1 trillion is only equivalent to one Vietnamese dong? That means you only need one dong to buy this house. Would you still think it's expensive? So, when the dollar loses value, the house also loses value. Similarly, if the dollar loses value, the debt also loses value. The U.S. is about to repay $6.5 trillion in June, and right now, the dollar index has lost 10% of its value. So hasn't the U.S. already reduced its debt by a tenth? And that's just the current result. If the dollar continues to lose value from now until June, when the debt repayment is due, the US will have to pay even less. That's just a first step. So how do you make the dollar lose value? By triggering a stock market crisis. This time, the dollar's sharp decline is due to the sharp drop in US stocks, which has caused global capital to flow out of the US and into other countries. So, the whole world is rushing to sell dollars, causing the dollar to lose value. If the US wants to pay less debt by June, don't they need to create another stock market crash, or even two, from now until then? The second step is to push gold prices up, causing both the dollar and global currencies to lose value compared to gold. Why? Because in the first step, when the dollar loses value, other countries' currencies will gain value relative to the dollar. But if both the dollar and those currencies lose value compared to gold, it means gold prices are soaring. So is rising gold prices good or bad for the US? Many people don't know that the US currently holds over 8,000 tons of gold, making it the country with the largest gold reserves in the world, more than the combined gold reserves of the next three countries. And that 8,000 tons is just the US's own gold. Many other countries store their gold in the US, like Germany, which has half of its gold stored at the US Federal Reserve. Including the US's gold and the gold deposited by other countries, the total is about 15,000 tons. And that's data from a few months ago. A few months ago, the US even announced tariffs on gold imports, causing the world to rush to transport gold from the UK to the US. So if gold prices soar, is that good or bad news for the US? It's good news, because the gold assets the US holds have increased in value, becoming more valuable. So, when the world stops buying US bonds, it's okay, they can buy gold, and gold is also a US asset. In other words, in the first step, the US lets the dollar lose value to pay less debt to the world. But the US doesn't just have dollars, they also have gold. In the second step, rising gold prices help the US offset losses from the dollar. One side decreases, the other increases, balancing overall. I've analyzed the details of this plan thoroughly in a video 2 months ago, which you can watch later. And the third step is to use tariffs to trigger a collapse of global assets and currencies. Combined with the Fed expanding its balance sheet and printing money to rescue, then redirecting capital from gold back to US assets. What does this mean? Let's look at the timeline again. Everything will become clear. The US needs to repay the $6.5 trillion debt in June. Meanwhile, tariff increases are delayed by 90 days, meaning until July. This means the task of devaluing the dollar to reduce the debt repayment will end after the US settles the debt in June. So, as mentioned earlier, if the US stock market crashes again, it's likely to happen around June. And by July, when tariff increases are restarted, global assets and currencies could collapse once more. In other words, a new global economic crisis could occur around July, and global assets will be heavily discounted, sold off at rock-bottom prices. As mentioned earlier, the Fed hasn't lowered interest rates yet, but that doesn't mean they won't when the crisis hits. If the 2008 and 2020 scenarios repeat, the Fed will not only expand its balance sheet and pump money into the financial system, but may also lend at near-zero interest rates, allowing U.S. capitalists to buy the bottom of U.S. stocks and assets. At that point, the U.S. stock market and assets will recover strongly, and the U.S. economy will recover faster than the rest of the world. At that time, other countries will continue to sell off their assets at low prices, exchanging them for dollars to buy U.S. assets. As a result, global currencies and assets will lose even more value. Meanwhile, the U.S. can push gold prices down to redirect capital from gold back to the dollar, U.S. stocks, and bonds. At that point, U.S. assets will rise from the ashes and boom, growing again. The fourth step is the simplest. U.S. capitalists can lock in profits at the peak, then use their appreciated dollars to buy the bottom of global assets being sold off at low prices. This is how you blow up the old house and build a new one. You might think all of this is just my baseless speculation, but that's okay. Let's keep looking at history. Economists have pointed out that when the Fed expands its balance sheet and pumps money, the money supply increases and money loses value, right? But look at reality. Before the 2008 financial crisis, the dollar plummeted. After the crisis, the Fed expanded its balance sheet, pumped massive amounts of money, and lowered interest rates, yet the dollar rose again. Similarly, before the 2020 stock market crash due to the pandemic, the dollar also fell sharply, but after the market collapsed, the Fed printed money without limit and lowered interest rates to near zero, and the dollar surged again. Why is that? Because reality shows that before every U.S. crisis, U.S. capitalists always sell their assets first, then move money overseas, inflating asset bubbles in other countries. At that time, the dollar loses value, while other countries' currencies gain value. But when the dollar and U.S. assets become too cheap, U.S. capitalists return to buy the bottom, and the Fed rescues the market by lending at near-zero interest rates, pushing U.S. asset prices back up. When the world collapses due to the financial crisis, but U.S. assets recover and rise, global capital is forced to pour back into the U.S., rushing to buy dollars. Meanwhile, global assets continue to be sold off, and the dollar keeps rising. In the end, capitalists can use their appreciated dollars to buy global assets being sold off at low prices. So, if everything now is increasingly resembling history, if since last year we've started accumulating gold, yen, and other safe haven assets, and now all those assets are continuously rising while the dollar keeps losing value, it at least shows that our investment strategy for the first half of the game was correct. So for the second half, let's observe how the U.S. government repays its debt in June and July, and whether they trigger another global asset collapse. If they do, at that point we can follow the trend, sell the appreciated gold and yen, and exchange them for the depreciated dollar. Then, wait until the Fed expands its balance sheet, pumps money, and lends at near-zero interest rates, when the dollar and U.S. assets are likely to rise again. At that point, I'll choose the right time to buy back U.S. assets. And in the end, when U.S. assets have risen, we'll continue to monitor the situation to decide whether to invest in the depreciated assets of other countries. Even if no crisis happens afterward, even if that opportunity doesn't come, we won't lose anything, right? We just withdraw capital and reallocate our portfolio. So, if you don't want to miss future market opportunities, what you need to do is prepare in advance. First, align your perspective with mine, understand the investment mindset and methods I share, then make them your own, instead of waiting until the moment comes and asking, should I enter now? Can I still buy this asset? I'm stuck with capital now, what if I'm losing? Because once the opportunity passes, who knows how many more years you'll have to wait. Recently, the world situation is only getting more volatile, but due to time constraints, I'll stop here. I share free knowledge on how to become rich, an entrepreneur, an investor, and achieve financial freedom. If you don't want to miss out, please follow my channel, turn on notifications, and share this video widely. I sincerely wish all the brothers and sisters who liked this video achieve financial freedom soon. As long as you find one or two useful sentences in today's video that help you live better, I'm already satisfied.